Maverick traders, welcome out to your Maverick Currencies midweek for June 15th, 2022. Today is Fed Day. We're going to have an FOMC meeting with most likely the largest interest rate hike in a good number of years, a couple of decades at least. And if you haven't traded through interest rate hiking cycles, it's not necessarily that it has to be really bad for markets. It's more about forward looking. And since the Fed's behind, since they're still in this quantitative tightening mode, it has been quite a dire market environment. But there are some signs of optimism. And I would actually expect the markets to kind of bottom out in here. Right around these levels. That sounds a little odd, but there's some big MACD divergences and some different things happening. But today's going to be volatile. That kind of bottoming out process is more something that will take place over the process of a few weeks, much more than a single point in time. As always, just a quick reminder, make sure that you follow your trading plan. Good position size, good risk management, always critical. So there's plenty of happenings out there. If you're looking at the crypto markets, you're looking at things cascading lower. If you're looking at other assets, probably much the same, just not quite as violently so. The CPI data last week was really a game changer. I mean, we reversed hard off of that. The markets had been in kind of a corrective phase, and then we just violently turned down. But below the surface, it's kind of interesting. So as you break down the CPI data, most of what's inflationary is things that we have to buy, right? Food and energy. But if you strip some of the energy aspects of it away, PPI, core CPI, core PCE, they're all making lower highs. So inflation is not running rampant everywhere. It's running rampant in a couple of specific spots that are particularly painful for consumers. And consumer confidence, my gosh, it's down in the dumps. Some of the consumer confidence numbers came in the worst ever in history. The consumer is pissed off and not happy with what's happening. But if you strip some of this away, so the way that you can break this down. So they figure, and whether this is right or not, it's going to be fairly accurate. Supply chain constraints. So that's a big issue. That's probably adding about 1.5. The Russia-Ukraine ordeal and oil directly 3.5. Higher commodity prices 2.8 on its own. You kind of strip some of that away, and most of what we're looking at is an inflation rate that's running at 2.3%. Now, are we going to get back to 2.3%? Well, we need a resolution in Russia, Ukraine. We need some of this supply constraints to be eased. We need specifically energy prices to kind of calm. And Russia, Ukraine will have maybe a big impact on both parts of that. But for now, the war continues on. Inflation is running hot, and it's something that is going to be a headline for the foreseeable future. But I still, kind of looking at this, you have to think that we're seeing inflation has rolled over in most parts of the inflation story. It's sticky and it's ramping up in the worst areas for consumers. People drive and people eat, and those are, usually the government likes to report inflation X food and X energy without those, right? Because that's not a high inflation number. But anyhow, it's not widespread inflation. In fact, lumber prices are down 50% in a very short period of time. Just in the past month, lumber prices are down and been cut in half. So that's not inflationary. That's deflationary, right? So now there's specific reasons for that. Rates have gone up. The housing market is expected to slow considerably because rates have gone to 6%, et cetera, et cetera. Builders are not rushing out to be building right now because they're worried about the future. There's some specific reasons, but just want to point out it's not like inflation's running hot everywhere. US dollar is broken out to multi-year highs. We've been on the the concept that the dollar would do this, it's happening a little quicker than I expected. I thought, we had the perfect kind of fake out move and then it plunged to the downside. I was on record thinking there was a little bit more down before we'd get this rally, but I think some of the data just fueled that. I mean, certainly it's a safe haven. It's somewhere that people go to in times of uncertainty, and this was a lot of that over the past week. So energy's been on a big run. We talked about that it kind of needs a rest and a breather. It's doing that. Energy's pulled back. Energy equities, for example, have come down significantly. And the crypto markets are broken, but I'm going to say something, I've every week I've talked about how bad the crypto markets are. Um, I think we're actually at kind of the exhaustion extremes. Now, that doesn't mean they have to bounce today or immediately or anything like that, but I would anticipate a pretty good, sharp rally out of crypto. I don't know that it's going to have legs and a lot of follow through, but be prepared if you're on the short side. Boy, I'd be tempted to take off the profits and lock those in as we've seen this plunge, because this is the type of plunge where things are kind of exhausted. Basically, they're forcing liquidations, margin calls, people running for the exits, like their hair's on fire, and that tends to create kind of an exhaustion low. So, as a trader, I'd be inclined to take profits. Now, I don't know that you aggressively go out and buy by any means, but I'll expect a pretty sharp rally. And maybe this time next week, we're talking about a big run where crypto is up 20% off of its lows. Not out of the question, and frankly, something that I would kind of expect in the near term. PPI met expectations this week. China production, industrial production, with a almost 1% beat. Retail sales here in the U.S. missed. So China is one of the oddball countries that's actually trying to stimulate their economy. They had shut down for COVID recently and are kind of ramping things back up, and actually they're in a more accommodative state governmentally. So expect to see, if you're looking at equities and so on, the Chinese equities are outperforming U.S. of late. I'd expect that to continue. Again, they're in kind of that accommodative mode versus the QT, the tightening mode that most countries, Europe, Japan, well, not so much Japan, the US, New Zealand, Australia, we're all in rate hiking mode and trying to create less inflation and combat that and so forth. China's in a little different spot. So the equity markets, like we talked about, big selling pressure last week. Interestingly enough, if you use something pretty simple like a MACD divergence, um, I don't use a lot of indicators, but I'll use a couple for specific purposes. If you look at this run lower, each one of these lows in the market, the MACD ran lower with it, what we would call convergence agreement in the downtrend. As we've made a plunge to a new low in the market, the MACD has gone higher. So that's called a bullish divergence. Basically suggests that the momentum, the energy behind this move, okay, the momentum or the energy or the power behind it has waned. That you don't want to press your shorts here. You want to be careful about shorting. You want to be locking in profits. That's the indication it's giving. Now, do I trust it? Well, it's the reason I use it is kind of as a leading indicator. It's not going to pinpoint what today is going to look like, but are we probably at a real bottoming out phase? And you're going to see a sustained stock market reversal for the coming months. I think that's where we're at. I'm on record here as of today as saying I think we're kind of carving out the general bottom, and supported by indicators like this one that say, hey, the pessimism is there, but the momentum is not. The energy, the selling pressure, it's not as severe as it was before. And those are leading indications of where you're going to start to see a reversal of trend. So I'll go on record as stating I think that's kind of where we're at here. Now let's take a look at a few different charts. We talked about the S&P. My best guess is, well, today volatile. I have no idea exactly what today's going to bring, but in the coming weeks, I think it'll shock and surprise everyone. When you have consumer confidence at all-time lows, when you have people so pessimistic and nervous and markets declining and CPI out of control and so on, you just stack up all those dominoes and every one of them is bad. Well, it's almost so bad it's good when you think about it. Anyone that's willing to sell has been given a chance and has probably been pushed off of that ledge. If you're willing to sell, you probably gave in to your worst case scenarios, your fears, all of that this week and have probably done so. So who's left to sell? Are there a lot of holdouts, people holding on? Maybe a few, but not much. So I think we're in the later stages of this downward trend. Now the US dollar, we've talked about this chart. Holy moly, what a chart. This goes back to 2020's COVID spike. Goes back even further than that, but you can see the kind of pop above, the fake move for a day, and then that plunge below. We didn't quite get low enough to kind of create the handle, the 30%er. It's a little shallow for that, but we've already accelerated to the upside. This makes the dollar, for me, very hard to trade. From a momentum standpoint, you almost have to be a dollar bull. From a trend standpoint, you got to be a dollar bull. We've broken out, and we're probably likely to go higher for the foreseeable future. But today is just a day unto itself. I don't know that today really matters in the big picture of the US dollar. If today's bad, the US dollar's still in great shape to trade higher in the coming weeks. And if today's good, well, it's still intact to trade higher. So I've got to lean bullishly on the US dollar given its momentum and trend and all those factors, but it's not at what I would call a sweet spot by any means where I just want to rush in there and trade it and feel super confident. So we'll pick our spots a little carefully. For this week, the British pound and the Kiwi are the two weakest. US dollar and Japanese yen makes sense. Safe havens, hiding out in those. Crypto land, everything's trash, right? Led by the biggest, Bitcoin and Ethereum. That's because last week Litecoin and Solana and all of those just collapsed. So this is kind of, they're not going down as far this week because they collapsed further last week, I suspect. But ultimately, crypto, to me, looks like it's kind of washed out on the downside. It had a big consolidation for a few weeks, and now this is another plunge, and I just think you got to be locking in profits. Market, 21K in Bitcoin. I suspect the next move, if you said where's the next 5,000 point move in Bitcoin, do we go down to 16 or we go back up to 26, that sort of idea, I'd pick to the upside. I think even if it's a dead cat bounce, well, dead cats bounce a little. So that's kind of where we're at. And a little bounce, by the way, would only take us back to where we were a couple of days ago, and it would still be a 20% rally. So can Bitcoin rally 20% and take it back to where it was a couple of days ago? Yes, it can. Careful and cautious, pressing your shorts. Let me at least emphasize that point. So as we look at this downward moving market, downward trend, I'm a little bit of a contrarian this week. I want to trade with the trend and with the momentum, but I feel like things are washed out on the downside in equities, stocks, and in crypto and so forth. And it's been a trade that's been the trend and the overall momentum for some time, especially in crypto. But I mean, you look at this chart, my goodness, the expectations that it's going to bounce is not something of an extreme call. I mean, we've really deteriorated in crypto land. So let's take a closer look. This is the international markets chart. Again, I think we're kind of washed out. This is that final phase, I think, of the downturn. Crypto, when you see massive volumes, just like this, just as that was an exhaustion low, we should be kind of carving out the general exhaustion low point. So I'd be a buyer in terms of at least taking profits on the shorts, and I might even sneak in there and buy. I've already traded Bitcoin. I made some money. It wasn't a huge return, but I did buy some on the recent dip overnight and took profits as it rallied, and I'm looking to continue to do that. So I'm already practicing what I'm preaching. It wasn't a huge gain. Didn't make a 5,000 point move in Bitcoin, but it was certainly enough on a percentage basis to be pretty significant. And I traded it in small position size. So kind of fun opportunities there, I think, where again, you're at that washed out exhaustion phase. And I'd much rather buy than sell down there. So, as we get prepped for this, interesting that the expectations coming in were for 50 basis point rate hike. That has basically changed in the past 2 days. Well, I didn't have a class on Friday, but I talked to our traders in terms of, Rob and the guys, and I said, look, they're going to raise by 75. And that became consensus this week. Now everyone, I think there's a 95% chance that the market expects them to raise by 75, so it's actually going 1.75. I don't think that's a shock and a surprise anymore. That's already been factored in. 95% probability in the Fed funds futures, for example. So it's going to happen. I think this is where the rate's going today. And then we'll kind of see, could the market sell off? Could the knee-jerk reaction be to sell because it was a larger than expected hike? Maybe, but I mean, I kind of think it'll rally. It's odd to say. They're hiking by more than expected. They're getting more aggressive, and yet I think the markets will look at that as a positive in the near term. So if I'm right about kind of where I think we're at in this whole big process, you're going to see a good sized rally in stocks in the coming days and a hellacious rally in crypto that'll only take us back to where we were a couple of days ago. But that's kind of how I'm looking at it and where I'm leaning on the trading side. So let's come in and look at a few currency pairs. Does anyone have anything specific they want to look at? Feel free to fire away. So I see the comment here. I have a quick question. Currently long in Aussie pairs, not against USD. Close them, then wait for the Fed news. Have a small profit in both. Well, usually you don't really need to, I mean, they'll move based on the FOMC news, perhaps, but I don't think it's a situation where you really have to feel, panicked about it or something. If you're in Aussie yen or whatever you're in, Euro, Aussie or something, it's not a situation where I think, the Fed news has to move it dramatically. All of the currencies will move a little. I mean, it's just going to send a little jolt of volatility, but it's going to be much more centered in US dollar pairs. So for the most part, we just kind of stick with the trade. We don't really, do any major deviations from the plan that way. So good luck on that. Aussie USD. So what if the market rallies? Do you play Aussie USD to the upside? So the short term versus the long term here. I mean, Aussie USD, I looked at a few of these charts coming in, and what you probably have here is an inverse cup and handle. And you're, as sad as that may be for Aussie, you're probably going to bounce a little further here in the short term, but ultimately trade below this level. It could double bottom here. It could do a lot of different things, but I would expect that it'll probably end up breaking these lows and trading below here in the coming days and weeks ahead. So as we measure this out, we kind of say, okay, 68.50 is the low. The high up here is just shy of 73. It's kind of, we'll eyeball it at about 72.80. So if you look at the size of that move, what I'm trying to get a sense of is, well, the size of the cup will tell me what the size of the handle should be, right? And the difference between the top and the bottom, or the entire cup, is basically, got to type it in correctly here. Could probably do that in my head, but a whole lot easier to use a calculator. So 72.80 minus 68.50 is about 430 pips, right? 0.0430. So the handle should be about 30% of the size of that. And 30% of the size of that is, if you multiply it by 0.3, it's 129 pips. So as you bounce from 68.50, you should go up to about, well, bounce by about 129 pips. That takes us to 69.79, which, dang blasted, is basically where we're at. So we kind of are at about the bouncy area. And, I'd be inclined to be more short on this than long. You're probably getting to where, you want to play this to the downside. So I personally will be looking, this is one of the pairs that I actually had on the watch, but I would be inclined to short it. And that's just the technical speaking. I think if the markets kind of bottom out in the next few weeks, that should argue for Aussie to strengthen and so on. But I don't know. We're seeing cross currents and different charts across different things. I kind of have to stick with the technicals much more than kind of guess out in front of it and say, well, if this happens, then this. I think we're probably going to have to look at that more on the short side. Oddly, so if we were looking at buying something against the Aussie, Euro Aussie kind of looks interesting, having a really bad day today, but I think Euro Aussie is going to go up and through that as well. So that's another one that I've been watching here recently. I don't have a position, but for your Aussie pairs, I think a lot of these things might trade above those levels against the Aussie. If we look at Euro versus USD, which we would be more apt to trade today, again, very similar setup and situation to the Aussie, but I would argue even worse in that can't even hold today's gains. So, Aussie, Euro, those are a couple of pairings. If you wanted to buy something against the USD, I suppose you could look at the Japanese yen, but I don't know. I've gone back and forth on quite a few of these charts and going, how compelling is this? How compelling is that? What do we think's going to happen? And I'm not sure I'm going to be able to pull the trigger here. But if you wanted to bet on US dollar weakening, I suppose, maybe against the Japanese yen could be a potential idea. I mean, the yen's been okay this week. That's about all I can say for it. But that would be kind of a defensive currency against defensive currency. But I don't think I'll play the USD to the downside today. I don't know. It's a tough one for me. I bet it's going to be a choppy trade one way or the other. We're probably going to see some volatility, and if I do anything, it's probably going to be more of the fading variety. Not try and guesstimate at what it's going to do ahead of time, but instead just let some of this craziness work itself out. And if it's maybe, the euro's bouncing a little bit versus the USD, maybe we short it, expecting that it'll go down and below this level. because ultimately that's what I expect. I mean, I think the trend on USD is such that sure seems like it wants to go break that support in the coming days and keep trending that way. When you're breaking out of multi-year levels like this, you have to give it some respect. Um, it already had its fake out and now it's recovered. Usually, when you kind of have a fake out and then you can play that quick reversal, if it's strong enough to get all the way back up there again after it faked out last time, it's probably really strong. So my inkling is that the US dollar rallies, and I think you might see equities rally, you might see Bitcoin rally. For a while there, we were seeing US dollar and gold positively correlated, where they were both moving up together. So anything's kind of possible in 2022. But I think for me, I'll be looking to play USD. I just have to kind of go with the trend and the momentum much more in that pair than anything else. So if you come into a little shorter time periods, you can kind of see where maybe the euro will get a little pop to the upside here on the Fed news, and then maybe we fade that for the next wave. Hypothetically, what would be an idea? Well, let's just snap a couple of things in here. Let's say we were going to short it on a little rally, and I'm not going to be too precise, but just kind of get some ideas in play of what we might kind of be looking at here. So watch this, and we'll kind of say, okay, for our stop, it would have to go above. Let's just move it up there a ways, and our target needs to go below. Let's move it down here a ways. And as I kind of come out in time, you might kind of be looking at levels that this could go to. I mean, realistically, we're thinking it goes to new lows, so your target's going to be a little bit more difficult to pinpoint. Your stop loss, I mean, I think if you're shorting it up here on the bounce, probably having a stop 30, 40 pips away just kind of makes sense up in here. And I mean, I could see something like this where you're kind of shorting it up into those short-term moving averages, and then your stop is maybe 30, 40 pips above, and your risk is about 40 pips. Your reward is probably 100 or more on the downside, but something like that would kind of be in the ballpark of what I'm looking at. Yeah, same thing with Aussie. I mean, it'd probably be a fading. If they try to sell off the US dollar, I'm probably going to be apt to buy. If the dollar just rallies, if this chart just goes down immediately, I don't know what I could do. Probably just goes without me. If they try to bounce it, I might act quickly to short that and fade that initial reaction, because I suspect it might then, see a continued pretty aggressive follow through, but we'll see. All right, moment of truth here coming up. Yeah, I mean it should be volatile, no question. All eyes on the Fed as we come into this meeting. However, the Fed's pretty transparent. We knew that 50 basis points was coming. Now it's adjusted to 75, and no one should be shocked by that. So, you know, should there be shock and awe at this announcement? No. Will there be energy? Yeah, should be. So watch for the pop, and I'll be ready to. I'm not trading on this platform, but I've got some stuff ready on my other screen. I may end up short Euro USD or short Aussie USD or something like that here pretty quick. So let's watch. Well, the initial, I'm not so sure the announcement's come out yet, because that does not look like the move. You should see a burst of energy basically when it happens, and you almost see a gap on the chart. It'll be trading here, and then all of a sudden, wham, it's trading at a different spot. So maybe it just came out. Okay, 1.75, not a huge reaction, but you can see how it's kind of climbing up into that area. And I think this is the trade. I mean, let's short it here at, 142.24 or whatever, right up in here. And I think that's kind of the game plan and the idea here. So I'm short. Let's come into a little shorter time frame. You see on this 15 minutes kind of up towards that upper Bollinger Band, but the actual short execution 104.20, so a little lower than what I'd shot for, but that's okay. 104.20 short, and let's see. I mean, we're risking about 40 pips. See if this thing can make that next wave to the downside. I think this is one where, I don't mind being aggressive on my stop loss placement. I'm going to move the stop. What's that above the 50 MA on this 15 minute is 104.48. I mean, right there you're risking. So we've got 28 pips of risk. Okay, I can live with that. And let's see if this thing will go to the downside. Let me click it on my other screen here because I need to adjust my stop. But I'm going to go to 104.48 on the stop. And let's see what happens. So yeah, I mean, if this rallies here, and it'll happen in an instant, right? It'll basically, if it's going to hit our stop, it's going to happen quick. It's going to happen probably within the next 2 minutes or something. If we can kind of build away from here, if you can kind of, each of these rallies kind of weaker than the one before and it just keeps bleeding off, then you're in the right trade here. But the more it hangs around, like sometimes I'll even move this stop down to break even, where if it's rallying and it just kind of keeps pushing upward, I'll probably just pull down that stop and break even. But this is good price action. You saw it try to rally and they pushed against it. Now we're getting a downward phase. Now, if they immediately push back up, that's what I'm talking about. You don't want to see that. Now you want to build a little bit of distance. It doesn't need to collapse, but just build a little distance down here. And then as you do the next rally, it'll be a little weaker. And then build a little distance, and it's kind of lower highs, lower lows. So right now, the price action looks very good. And we just stay the course. I mean, this thing is acting the way we want it to act. Now, I didn't really put my target out here at any specified, excuse me, sorry. Tried to mute up and didn't catch it. Excuse me. Oh, as I announced last week, I was battling COVID. Hit me pretty good. So I think in terms of targets, you could target. I'm wondering if there's any channels in here. Kind of ideas, concepts here for targets. Because we're just kind of guesstimating at the downside. But, somewhere down in that range of 103, 30s, 40s, something like that could be a quick target and take some money and run. I mean, the trade's really running to the downside. The more you accelerate to the downside right here and now, the more apt I am to take profits, because it's not so much that this is like a long-term trade or something. We're trading this just on this Fed meeting, so kind of tempting to take profits on half, and I think I'll do that right here at 103.80. Let's take profits on half, and that'll lock in 40 pips. I'm just doing it on my other screen, so You know, right here at 103.80, take off half. I'm going to leave my stop in place at the same spot. So, you know, I think this makes sense to basically kind of trade the back and forth. Now on the next rally, if you wanted to consider putting the half back on, you could possibly consider that, but I think at this point we'll just see if it keeps accelerating and this plunges here in the short term. I'll probably take profits on the other half, and then frankly I probably would at least put a half position size back on the next subsequent rally, but we'll see. Good price action here out of kind of what we expected. All right. Well, I don't know that there's anything else really to watch and to see other than I think this is a place to take the other half. Let's take off the other half right here. So taking it off right here. Okay, 103.62. 103.62, you know, that's almost 60 pips of profit. So you had about 50 pips of profit on that trade, pretty quick and easy. That's not too shabby. Now let's think about, you know, next phase. Do we get back into this thing? Let me cancel those. As far as a re-entry or something like that, I mean, you got a little channel here happening. You could take this candle and, like we talk about with price overlap, break it into 4 sections and then kind of short up here at the top part of this second section. That would put you re-shorting at maybe 103.90, you know, somewhere up in there. But that's kind of the area where I'd look to get back in on this. You know, I think this will continue to be wishy-washy. Don't forget, you know, when you've got Fed meetings, you've got other flow, you've got potential statements by the chairman in press conferences and so on. There's always other factors in play. So the initial trade was a good one. If you got short Euro USD on that initial pop, well done. I think that was the trade. Next phase for me will be considering a re-entry somewhere up in the 103.90s. Right up in there would be where I would consider it. And we might get that here in short order. If I do, so let's say we short again at 103.95 or something, probably put in your stop just above this level. You don't really need to risk a ton with these. You know, stop up there where you're risking 27 pips and play it for another phase down into the low 103s, you know, where you try to make another 60, 70 pips. I think that makes sense. I think you can just keep playing the back and forth here a little bit, but so far so good. You got some profit in your pocket, so let's keep looking at this as an opportunity. All right, well, we'll leave it there. Nice trade on the Fed meeting. Short Euro USD got it done this time. Yeah, you could have, I mean, the same idea would have been with the Aussie. So if you were trading that one, it's going to have basically the same chart. If you shorted the pop, you got a nice profit on the downward move. Now you might be considering the bounce back for re-entry or something. But Euro was more trend-based, more, more in our favor in the short term. It was, like we said early on, it was even weaker than the Aussie. The Aussie had bounced back against the USD. The Euro tried and failed, so I kind of preferred it. That was my area of focus. All right, we'll leave it there. Thanks again, everyone. Have a great week. We'll see you next time. Goodbye.